new, some going to be old. It's a mixture of stuff that is stacking on your go down or on your ranks, shop ranks, or whatsoever. This is normal business practice. So the way you allocate these costs determines your profitability, your taxation, and of course your profit measures like profit margin, finance stuff, right? So if you allocate recent costs, a customer came to you and you sell at $10. If you allocate recent cost, so it means you are getting $0.5 profit on per shampoo. If you allocate 6 older prices, then 10 minus 6, it is $4 per bottle. Look at the huge differences in profits. So if you allocate recent prices, your profit will be showing low. If you allocate older prices, then your profit showing on the balance, on the income statement, $4, right? So that's why it is said here, the accounting method that you select for calculating the cost of the inventory, it also affects the profits and the taxation, right? If you allocate latest prices, your profit will be lower. When your profit will be lower, of course, your taxation in total, in number of, in figures, in dollars term, is going to be lower. If you take the older prices in which you get $4 profit, your profit will be higher, and of course the government taxation in total dollar terms is going to be higher, right? So it means there is a chance for manipulation because there is a judgment involved here. This is of a subjective nature stuff, right? So as a manager, if my responsibility is to decrease the taxes, I will choose that method in which I have to pay less taxes. It means I will be choosing that costing method which will give me highest cost, so that my profit looks on books lower, and I show to the government, look, my profit is lower, and please, that's why my taxes are lower, because nobody want to pay higher taxes. Whether the tax is straight 30%, but still when you multiply with a bigger number, tax in figure is going to be bigger, right? Or if my bonuses or my job is to earn highest profit, so whether my sales are not very good, but I record the inventory on older price basis. So on the books, on the income statement, I show higher profits. And I will, boosting on my annual general meeting, I said, I'm a good manager. Why? Because under my rule, the profits, look at the figures, the profits just shoots up. And I deserve this kind of stock option, this perks and benefits like that, right? So as an accountant, you should be aware of that. There is a chance of manipulation here. There is a chance of subjective nature here, because choosing the accounting method, gonna change the profit as well. When the profit is going to be changed, of course, taxes is going to be changed. So the government officials, they also need to be very smart when they see this kind of stuff. Of course, nobody wants to pay taxes, right? So whenever the income statement comes to their taxation department, so they see what's going on, whether this is a deliberate move or this is the situation of your company, right? Everybody want to pay less taxes, so every company in a country start using latest methods, and in that case, government receive less taxes. So governments are also watching the security and exchange and all those stuff, because the financial statements are publicly published. So they are also watching all this stuff. Okay, so that's why the companies, they hire taxation, advocates or employees whose work is to minimize the taxes, and government department is to extract maximum taxes. So I'm not going into the taxation setup, whole new stuff. That's why we have a separate, subjects on taxes. So just going to give you the idea here. So we have four inventory methods. One is specific unit method. Number two, average method. Number three, FIFO, which is first in, first out cost method. And LIFO, last in, first out costing method. So company can use any of these methods. So methods can be very different, can have the very different effects on reportings, the profits, income taxes, and cash flow. Let's just talk about one by one. What is specific unit method? So this method is used for the businesses with unique inventory items. You are making jewelry, customized jewelries for Rihanna, for for Jennifer Lopez or whatsoever, or you are making specialized BMW gold-plated or gold color, this kind of stuff. So your unique items, normally antiques, automobiles, real estates, right? So you know that, okay, this cost me like this. So it is easy. So there is no chance of judgment here. Okay, you cannot apply the same rule on all the items here. All the furniture items, all the automobiles, all the real estate, all the jewelers, you cannot just apply the same costing methods to all the items because every item is unique. So businesses cost their inventories at specific cost of particular units. So these are too expensive, right? Because in order to sell these kind of stuff, you also need a specialized person who knows. For example, artwork. If you hire me to sell the artwork, I don't know the nitty-gritties here. Maybe I may not be able to sell at higher price because I don't know the that artistic mind and all the stuff. But if you hire those person who know the arts, and they just figure out, okay, where to sell it and how to sell it and how much to sell it, so they know that the price of this simple art piece or antiques kind of stuff. So this is very expensive inventory method, right? So we also call this specific identification method. So there is no rocket science here, right? Average costing method. So it is applicable to that industry which makes the same product. That's it. For example, a company is making a pen or a keyboard or mouses. That's it. So you can say that, okay, this is the cost divided by number of units. That's it. So this is my cost. We also called it sometimes weighted average method. So you just can find out if average is there. So we must be talking about the average costing method. So let's talk about the illustration here, how we calculate the average costing method, how the cost of goods sold or the value of inventory, how we calculate on the basis of average. And it's very simple. So all these methods look scary, but they are very simple. So let's just talk about this. So we have exhibit 6.6 from the book, and it is Family Dollar began the period with 10 lamps that cost 10 each, right? So their beginning inventory is they have 10 units from previous month or previous year, and previous year or previous month they bought it with $10 each lamp. But now they ordered 50 lamps and sold 40 lamps. So 50 lamps the order is given in 25. Two orders they place of 25 units each. So order one cost them $14 each. Order two cost them $18 each. So it means $350 they bought at 25 units, and $450 they bought at 25 units for order number two. And they sold 40 lamps, right? So they sold 40 lamps, and it means 20 left. So if you're a layman, then even then there is a challenge for you. So they sold 40 lamps, right? So which lamps they sold? From this 50, or from all these 10 this, 25 this, and 5 from here, the last purchase order number 2, or they sold from both order number 1 and order number 2, right? We don't know.
We don't know.
So that's why we need methods, right? So average method is you find out the average cost, how much units you have and how much it cost you. Simple. Here we go. So in order to find out the cost of those 40 lamps, you just average out. So right now, how many goods are available to your business? 10 and 50, 60 units. And what is the cost? 100 plus 350 plus 450, 900. So what is the average cost? 900 divided by 60.
400 divided by you. Okay, I understand.
900 divided by average cost. Simple. Oh.
It's 15.
Here. 15. Right? So you see, we smooth out every process. We eliminated this kind of possibility, okay, we sell it from latest or sell it from previous one. Just we eliminated all this stuff. This is not our attention. We are attention free. So we sold 40 units. So what is the cost of those 40? 40 multiplied by 15, 600. And how much units we have right now? 20 units out of 60. And what is the cost? Multiply by 15. So here it is 300 and cost of goods sold is going to be 600. It means you average out, you smooth every process. In finance, we call this normalize, right? We remove the effect of inflation, right? See, inflation is there, clearly there, because they purchase $10 and then next order is $14 and then the next new order is going to be $18, right? Simple. So you see, inventory left 15, cost of goods sold of those 40 units. So we didn't multiply it with 18 or 14, we just multiply simple rate 15. So we average out everything. Now, other methods. Now, first in, first out. So what do we mean by that? So let's see. First in, first out. So if, for example, this is the goods are coming from different orders, right? So these orders are coming here to your shelves here. So first in, so first in will be sold to customer first, right? And then this inventory, and then this inventory, and then this inventory. So there is an order system. So let's just talk about this. First cost into inventory are